3, 2, 1. Welcome to the show.
All right. Starting Q2, first week of April.
Q2.
I can't decide if I feel like this year is going by fast or slow.
It's zooming for me. I don't know about everybody else. I don't know. I feel like as I get older, first of all, that's whenever you start a sentence like that, I feel like it's getting older. You know you're getting older. But anyway, like, I don't know. It's just like the months are flying by. I feel like the other day it was like January, February, and now we're in April. I don't know. I like it to slow down a little bit.
Yeah, I'm glad, though, it's getting a little warmer out, and
that is
spring
nice.
is coming. That is a good thing.
Yeah, I am ready for some warmer times. Yeah. I'm ready for some better market times. Are we going to get there?
Someday.
Mm-hmm. Maybe.
I mean, in the meantime, I'm trying to make it so we get whatever gains are available on the table, but, man, it's not easy.
Yeah, it's crazy.
There's definitely not a trend, like not a really good tradable trend for given the 2-move-a-month rule and the noon rule. It's very, very difficult.
Well, that's the important part of that sentence, right? It's not that it's not a good trend. It's not a tradable trend.
For us, right.
Very different, right? Because some people would argue like, oh, well, and I'm sure you're going to talk about this at some point, even if it's on the charts, the weekly charts, but like you could look at this week and be like, oh, if I was in, this day and that day, great, but like, we only got two moves a month.
Right.
There's only so much we can do with that. It's just kind of churning right now.
Right. I mean, it is churning. That's exactly right. And you can see it in the chart. And, you hear people talking about if I would have been better off if I'd have done, X, Y, or Z, whatever, I'd have been better off. And especially since like year to date, right? The S&P was at a low at the very end of December. And so when you start off at a low and the market moves higher, churning or otherwise, you're going to have a higher rate of return. To get, using our methodology, if you're at a low, you're not getting back in. You're waiting for some kind of bottoming pattern, a breakout to the upside, and then you're getting back in. So you're going to be behind the power curve. It's for a year-to-date perspective. That's just the way it goes. But if you go back and look at a 1 year or a 3 year or a 5 year, and you can start to see the differences in how the methodology works out.
Yeah, and you're actually going to do that for our members call, right? So we're going to have, just heads up, if you're a member of our site, a paid subscriber, email went out yesterday. No, this is Sunday, sorry. Email went out last week. It's going to be on Wednesday, April 12th.
Yes.
Yeah, Wednesday, April 12th, 6 p.m. Eastern time. Yeah. You got to do the math if you live somewhere else.
Right. Yep.
But anyway, one of the things that we're going to kind of look at, this is a very interesting month for our performance. Jerry and I noticed that like the 1 year, 3 year, and 5 year chart, if you break them down and kind of get a good picture of that, you'll see how this methodology plays out, the way we do this, right? And let's say you take the COVID low out of it, it's going to look different. Like if you just take that data away, like it never happened.
Right.
So Jerry's going to break. Like I think it's some useful. We didn't put it on the website because it just makes the page too long. But anyway, if you remember, we're going to talk through that.
Yep. There's a lot going to be going on that call, so you definitely want to be on it. Okay. Podcast April 9th. So we're going to talk about. We've looked before at Stock Traders Almanac. One of their core strategies is this thing called best 6 months, worst 6 months. So we're going to take a look at what exactly that is, and I'm going to try to not give away too much proprietary stuff on behalf of Stock Traders Almanac, but at least I'll put the links in there, and you guys can go to them and subscribe to them if you like. And Larry Williams, we've talked a lot about him. He was one of the guys that was bullish going into this year, one of the very few, because if you remember, everybody thought the market was going to tank the first half of the year and then recover the second half, and he said, nope, it's going to be the opposite. So we're just going to get an update to his forecast. Then we had a request for us to take a look at VGPMX, which sort of similar to the iFund, but not exactly. Actually, not exactly at all, but it's an international fund, and we're going to take a look at that and compare it to the iFund, and then the weekly charts. All right, so Stock Traders Almanac. So this is pretty timely, which is why I wanted to do it. Jeff Hirsch is the publisher of Stock Traders Almanac. That's the Tumblr site for it. Even if you just go in there, and I think you can just get on the email list to get on the Tumblr site, but there's a lot of really good stuff in there.
Did you say Tumblr?
Is that Tumblr?
They actually have it on Tumblr?
Yeah.
Wow. I didn't know people still use that.
He's old school.
Old school is.
he took the business over from his dad, and
holy cow! Yeah. I'm gonna have to go look at that site just to see what's there, because I didn't think anybody's on Tumblr anymore. That's hilarious.
What's the one we were talking about last night?
Substack.
Substack. Yeah. No, he hasn't made it out to Substack yet.
Holy moly! I'm sorry, you got me there. I was like, where are we in 1990? Where'd we go?
Well, he's not on MySpace at least, so that's good.
Well, it doesn't exist. So if he was, he'd be alone.
All right, so so I'll kind of explain this. I think we'll get to it, but Dow Jones Industrial Average. Okay, so Dow Jones Industrial Average, S&P 500, and the NASDAQ are like the three big indexes in the U.S., right? So he uses the Dow Jones Industrial Average to validate S&P 500 triggers. So a couple things to take away from here. April is the final month of the best 6 months for the Dow and S&P 500. So the best 6 months are November, December, January, February, March, April. Okay, so April is the last of the best 6 months. So the window of our seasonal MACD sell signal opens on April 3rd, first trading day of the month of this year. So what he's saying here is, beginning on April 3rd, the MACD sell signal, if you get a daily cross down in the MACD, that's the trigger that's the sell trigger that begins the worst 6 months. Does that make sense? Okay. So you got let's say November to April, through April, right? And somewhere in, then you have May through October. So somewhere in October, you're looking for a positive MACD cross. And the way this methodology works is when you get a MACD cross positive of both the S&P 500 and the Dow Jones Industrial Average, that's your trigger that is going into the best 6 months. So you go into the stock funds on the MACD positive crossover in October, and you stay in the stock funds until the negative MACD crossover in April, right? So it's a very simple system. And, I basically just explained it relative to how you would do it in TSP. I'm going a whole lot more into it in the newsletter. But it's a very simple system, and if you wanted to do it, it works pretty well. And in fact, from the Dow Jones Industrial perspective, he didn't have a chart in there of the S&P 500, but it's relatively similar. And he's talking about the value of this relative to a buy and hold strategy. So in the Dow Jones Industrial Average, I couldn't figure out what his starting numbers were here, how he goes from 0 to 3.5 million up here. But basically the point is, if you were in the Dow Jones Industrial Average only during the worst 6 months of the year, going back to 1950, all right, you'd be negative. If you used this strategy, you'd be pretty far positive. And if you used just a buy and hold, a simple buy and hold strategy, that's where you'd be. So it's pretty simple because you're only making 2 moves a year, and it tells you exactly, you have to look in during the month of October and the month of April are the only 2 times you're even really looking at it, and you're going to buy or sell on that MACD crossover. So it's pretty interesting. And going back to 1950, those are some pretty good results. So it goes along with this whole idea of sell in May and go away, right? All right. So that is where he calls that the tactical seasonal switching strategy. Definitely go check it out at stocktradersalmanac.com. All right. The other one we wanted to talk about was Larry Williams. Okay, so yeah, talk about Larry Williams. So we've shown these next couple of charts we're going to look at a few times, but so for a preview into this chart, I just want to say this is a quote from his a slide that I pulled off of one of his slides. So don't think that 2023 will look just like slide or chart 17, which we're going to look at in a second. Price will fit for the twists and turns, but not for the overall trend. Consider it a timing tool, right, for when rallies begin and end, but not as magnitude. Okay, so let me just flip this for a second. These dates are the pivot dates. Okay, this is the general way he sees the market going for the year. Right, this is the S&P 500. So the magnitude of the move isn't what he's talking about. It's just the direction. Okay, but what's really important is the dates that he thinks are going to be the turning points. So we'll come back to this part. So here's where we were in real life. Right, this is a chart that's going through basically. I think it was Thursday of last week. Here's the December low. Okay. Here's the December low. He's got us running up through February, through the beginning of February. And the turning point is March 10th. He's saying March 10th is when we should start going back up, right? So this beginning of February into March 10th should be a down move, consolidation to down, right? So we got this big rally into the beginning of February. And we got this move down. It went to March 13th. He says March 10th. He was off by a couple of days, and it might have been a weekend. He pretty much hit it to the day. So here we are at March 13th. The rally starts back up. And on his projection, we go up to May 10th. So we will see if we keep getting up here, and it's consistent with what we've been talking about at 4,200 on the upside, 4,300 at the most. Because if you guys remember, and we'll show it, that's the August high. So it's very possible that the rally keeps going through April. You know what? Let me go back to this real quick. I'm sorry to be so kind of disjointed, but there was something I wanted to talk about on this one. So April's the final month of the best 6 months. Okay. April 99 was the first month ever to gain 1,000 Dow Jones points. From 2000 to 2005, April was hitting a decline for 6 years. But from 2006 to 2021, April was up 16 years in a row. So the bottom line, April is now the second best month for the S&P 500 and the fourth best month for the NASDAQ. Okay, so April, historically, and on average, this is right now, after compiling all that together since 1950, April is the second best month of the year for the S&P 500. So if you kind of take that and bring it over to what Larry Williams is talking about, he's expecting, again, April to be really positive. And this is opposite what all the analysts were talking about for the year. Everybody expected the market to come down for the first half of the year and up for the second half. And this was his forecast that he put out in December. He said, nope, it's going to go up. for the first half and down for the second half. So ireallytrade.com, you can still buy his 2023 forecast that came out in December, and it goes, obviously through the end of the year. So it's worth taking a look at. And we will keep updating you guys as to where we are, but definitely if the rally keeps going in April, when the beginning of May, this is sort of a buy the dip mentality until the beginning of May, and then it's sort of a sell the rip. All right, so those are basically two kind of different, certainly different methodologies than what we use, but you guys can check them out and see if they fit with your personal circumstances and risk tolerance. All right, so bonus chart, VGPMX. So you can buy this in the mutual fund window. It's a Vanguard product. It's Vanguard Global Capital Cycles Fund. So the fund looks for opportunities arising from changing investor sentiment resulting from cycles of under and over investment in capital-intensive industries. So at least 25% of the fund will be invested in precious metals, okay, and mining securities. So if you've heard on the news at all, there are a lot of economists that think that going forward, precious metals and mining, hard assets basically, are going to do really well in this environment. It also focuses on opportunities to invest in companies with scarce, high-quality infrastructure assets, right? So again, hard assets, typically utilities and telecom, that are viewed as irreplaceable and therefore have enduring value. In addition to stock market risk, the fund is subject to currency risk and country risk. Long-term investors seeking global equity exposure who are comfortable with the added volatility of international investing may wish to consider this fund. So it's not like the iFund. It's only like the iFund in terms of it's global, but it's focusing on hard assets, precious metals, mining, and high-quality infrastructure assets that have enduring value. It's a hard asset fund, which should do, if things go the way everybody predicts, it should do really well. So here's what it looks like relative to the iFund. The Global Capital Cycle Fund is right here, and the iFund is in orange. So they correlate, but not exactly, right? So back here in 2020, the iFund, is at 60 or almost $60, and VGPMX is down here about 52. And so they're correlated more or less going into COVID. They both crash in COVID. They come out, the iFund is doing better. Here was the transition point, right, which is basically the top in stock market in January 22. So since then, investors are much more interested in getting into hard assets. And you can see it as it plays out in the chart, because this is the iFund, right? The stock-focused fund is going down relative to the hard asset-focused fund, which goes up and down. But at the end of the day, it's above where the iFund is, even though back here it started the reverse. So it's basically showing you that investors are definitely moving from a stock-based international stock funds into more hard assets, and we have a higher high here, right? We're not anywhere near it in the iFund, and so I would say that's a very strong. I mean, we've already got a higher high, so I don't know if you need to wait to get above 1250 here, but yeah, it's clearly in an uptrend, and if things continue to go, if inflation continues to go higher and currency problems and everything else, this is a great fund to be in the mutual fund window. Good. I think we're pretty good. Okay, I knew there was an extra. All that stuff makes sense?
Yeah.
You think? What'd you do?
You kicked one of the cables, and I was like, "Oh, there goes the camera." I got to get those cables off the ground. None of you guys can see the chaos that's outside of the camera picture.
Yeah, right. All right. So hopefully that, a couple of different things, some different flavor from what we usually do.
Yeah, we still got to circle back and do sort of a wrap up of our experience with the mutual fund, because you are obviously in it. But my takeaway from watching you play it was that it could be a valuable tool if you're willing to do a lot of work, and yes, you don't have the restrictions in trading, but you got other restrictions, right?
Yeah.
I mean, other restrictions being the fees associated. So when you make trades, you've got to take that into account. How much a percentage of your portfolio can you, all those things. But at the end of the day, if you're really into this and you're really willing to put the work in, you might be able to squeeze out a few more percentage points each year by having part of your portfolio in there.
Sure.
Would you agree with that statement?
Yeah, 100%.
Yeah. I think it'd be good to kind of circle back at some time this year and just give people a kind of an update on that.
Yeah. I mean, I don't want to use it. You could almost use the mutual fund window as like a not day trading, because it's mutual fund, so you can't day trade it, but you could trade it every day if you want.
Yeah, you can trade it day to day. That's better.
Yeah. So since you can do that, if we were in a trend that I thought was, going to be moving in a direction for a certain amount of time, if I could do the extensions and project out to where I thought it was going to be, I would be inclined to get in the mutual fund window.
When the whole market is doing this, it's hard even in the mutual funds, right. Unless you're really dialed in and it's day to day, better than day trading, still not possible. But say day to day within the week, you're in, you're out, you've got your shorts, and you got like you'd really have to put a lot of work just to squeeze out a little bit more. But if you're really into it,
you can do it.
You could do it. For sure, because you're still trading day to day, so you don't have to obsess over it throughout the day. You need to obsess at it after dinner every night.
Yeah, right.
Or for breakfast,
because you only get one price. For the day,
and so you'd have to do it, early in the morning or in your evenings, and you could play the heck out of it, right? Yeah,
for sure. I mean, one of the ways to do it, if you think that hard assets are the way to go, then a fund, like the one we just looked at, is something to like buy and hold, basically.
Right.
My brain doesn't work that way. So, I'm waiting for example, if we got below the October low, then I would buy an inverse S&P 500 ETF or, fund and let that go up as the market's tanking, right? Or vice versa. If we get a serious breakout in the stock funds, you can go into the ultra S&P fund and do twice as good as you would do in the C fund. So, but this churning, this up and down, constant up and down that we're in right now. Yeah, I haven't been in the mutual fund window in months.
Unless you can day trade, it's hard to play to really get much out of this kind of zigzag, correction, right? Yeah. It's just a churn, and and we were talking about before the show, talking about just how all these competing narratives there are out there, how all these different versions of the story. You've got, Bloomberg telling you one thing, and you've got, some folks that you watch on YouTube telling you another. And then at the end of the day, what you see play out in that and action within the market is confusion.
Yeah.
Right. Which is this back and forth. That's what a correction is, right? It's just like, I don't know where to go. Like, this is the market speaking to you, telling you, I don't know where to go right now. There's too much going on. And then at some point when the overwhelming narrative is good or bad, the trend changes. Yeah. And that's what we're waiting for. And if you're trying to play the game, can't play this game in a TSP very well because of that churn. But if you're playing it, in a brokerage account or something, it's still hard because you've got to be really dialed in. And you got to pick your poison. You got to pick which ones you're going to watch because you can't watch everything.
Yeah, and it's really, really hard to overcome a guaranteed 4.5%, whatever it is now in the G fund, guaranteed, versus trying to pick a bottom and pick a top and 2 moves a month and noon rule and everything else. It's awful hard to I mean, it's not the sexiest thing around to be in the G fund, but there's zero risk.
Yeah, and that's what it comes down to, right? Is if you're willing to risk it, and if you truly enjoy doing this, right? That's different. Like if you're going to do it anyway, great, then get in there and do it. But if you don't want to do this stuff, and you've got other hobbies, and you've got a life, and you've got work, and then why would you spend all that time doing something to squeeze out maybe 1% more? Yeah.
No, that's what we do. But it's our job.
But that's our job. That's different. That's what I'm getting at. Like, unless you want it to be your job.
And if you did want to squeeze it out, the extra % or two, I'm gonna show you how I do it on this next chart. So this is kind of the level of stuff that if you're a subscriber to the site, you would get. And I just want to go over a couple of things. So this is a 1-year chart of the C fund. Okay, each tick is 1 day of price movement. You got a 20-day exponential moving average line in blue, relative strength, and MACD for technical indicators. So my favorite tool is divergence between RSI and price. Okay, so what do I mean? We had basically 1, 2, 3, 4. In the past year, we had 4 kind of turning points, okay? So you got the top of the August high, right? So this is the first big rally that we had in the bear market. So price comes up, right? And you would expect that relative strength is at a bottom, and relative strength goes up as price goes up, right? Which makes sense. As price keeps going up into that high, relative strength is going up, but MACD histogram is falling off, right? So what we're looking for is either strength or weakness. So ideally, price is going up, relative strength is going up, MACD continues to go up, histogram keeps going up, these lines cross, they keep going. At some point, you're going to get some weakness and some kind of a pullback. In this case, it pulled back to that 50 line, which is great, but then kept going through it, right? And you can anticipate that because the histogram is already coming down. So it's giving you a heads up, right? So it's giving you a heads up that not that this is exactly where the top is going to be, but just that it's getting ready to roll over when RSI and MACD diverge. So that was the first one. Then we get to the bottom, and so the opposite is happening at the bottom, right? You got price. We put in a low right there, but we've put in a final low in October right here. But so here's price. It hits a low in RSI. Even as price continues lower, RSI has already started to turn up, and the MACD has already crossed positive. So the momentum is shifting. Even as price is coming down, momentum of that price decline is decreasing, and so a turn at the bottom is let's say imminent. It doesn't say exactly when. It's just that this divergence gives you a heads up that a bottom is coming, just like this divergence gave you a heads up that a top is coming. Okay, it doesn't say the exact time. It's just giving you a heads up. So that was the second one. I'm going to call this a third one. Both of these together. And this is what makes this market really, really tricky. You got price basically flat, right? A double top. But you got RSI turning down, and MACD had already crossed negative. So with price holding up, but the technical indicators rolling over, you know a top is coming, right? And this is a daily chart, so it came basically the next day. And then we broke down through that 20-day moving average line, and that was our sell trigger, right? But then that's fine. It's a sell trigger. And so you'd expect the market to come down for a while. But that's not what we got. We got a big move through that 20-day moving average line, and then pretty quickly a consolidation, right? So RSI comes down. As price is consolidating, RSI starts turning back up. MACD turns up. Histogram, right? Crosses right there. that day right there, once we got back above that 20-day moving average line, now we have a buy trigger again. So just because you have a sell trigger doesn't mean price is going to go down for a long time, or if you have a buy trigger, it's going to go up for a long time. This one was easy to see, but tricky because if you only have 2 moves a month, this isn't playing out over a very long period of time. And then I guess the most recent high in February, we have this consolidation, I'll call it, because it's still above that 20-day moving average line, right? So it's consolidating above there. RSI is coming down. MACD has already crossed negative. And then once we got confirmation, basically, by a close below that 20-day moving average line, that's the sell trigger. So it's my favorite tool. This divergence is my favorite tool. And what we're looking at right now, right, there is no divergence. We rallied. We've been rallying since middle of March. We pulled off a little bit this week, but there's nothing to compare it to. There's no divergence. And so you let the market play out. I mean, that's my perspective. I want to see the market play out. So
at the end of the day, so divergence is normally the signal to you that something is going to change.
Yes.
Whether up or down, but that there's a divergence is signaling a trend change.
Yeah.
And so then, you still have to. You don't have to. If you made your decision right at the divergence, you're still guessing.
Yes.
Right.
Definitely.
So at divergence point, if you're not risk averse at all, and you're just like go for it, right, that could be your sell or buy trigger.
Yep.
However, because we have so many restrictions, we have to let that play out. Yep. Right. So that might have gotten a little lost in that, but that well, then why don't we make those moves right then? Well, you could if you could just get in and out willy nilly. That'd be fine, Yeah. And a lot of people do play that way, not in TSP, but when they see a divergence and if that's their buy or sell trigger, they'll pull on it, right? But they're already ready to get out or back in, right? They've already picked their next line in the sand,
right?
Right.
So we're going to talk about that quite a bit, actually, in the members only call. If you, I don't want to show it in the chart. If you get, you start to see a divergence. Let's say price starts to consolidate and RSI starts rolling over, and you say, okay, I'm getting out. I could give you a ton of examples just in this year that if you do that, price consolidates, RSI comes down to that 50 line, and then finds support at that 50 line and turns back up. Right. And goes on to rally to new highs, and you missed it. And if you miss it there, when are you going to get back in? Yeah.
Again, like you said initially, though, it is just a heads up.
Yeah, it's a heads up.
Right.
I wanted to confirm.
Right.
Right. That's
well, now, we definitely wanted to confirm because we don't have options to get in and out very often. Right. So we're looking at 2 moves. We have to let it confirm, and we're always looking for the big trend changes, not the small ones.
Right. Ideally, that's what we want to be in. But as we talked about, it's very hard right now. So, all right. So hopefully that gives you guys an idea of the kind of the level of analysis that we're doing. If you're a subscriber and you like that, sign up at growmytsp.com. All right. So the basically I'm calling them 3-year weekly charts. I like to leave this COVID piece in here just for some perspective. At some point, it's going to have to drop off. But 20-week moving average line, now in blue. Same thing, RSI and MACD, but it's on a weekly chart. So each tick is a week instead of a day. So the idea is that when price is above that 20-week moving average line, when it comes down, it always finds support there, right? Support, until it didn't in January. And now you have a downtrend. So when price is below that 20-week moving average line, you're in a bear market. Right now, we're above it. And so we're also above 50 in RSI, and we're positive in MACD. So that's not saying that the market is necessarily going up from here. this chart's basically telling you that when price is above that 20-week moving average line, as long as it stays above it, then the angle of the line will move up and price will move up. So the only way that the rally can continue is if price stays above that 20-week moving average line, right? If price is down here below it, moving average line starts going down, price is doing this, right, and it's going lower. So just because we're above that line, like last week, doesn't mean that you should necessarily buy it. It just means that now it's possible that the trend can continue up. It's a distinction hopefully people can understand, because in the bigger scheme of things, this looks really bullish. And we are above 50 and MACD is cross positive. So there's nothing wrong with being in the stock funds here. I'm just trying to say that just because it closes, it's a buy trigger, doesn't guarantee anything. That's all. Okay. S fund, not as good, right? We came up last week. We closed right below. Let's see if I can zoom in here. Last week closed right on that 20-week moving average line and then rolled over this week and took out almost all the gains from last week. So not what you want to see. We wanted to see it pop up and get back above that 20-week moving average line. And as we would expect, RSI rolled over and it's below 50. MACD is negative. So it just means that, a little bit of work needs to be done, but we still have a pretty bullish pattern that we're looking at here. So, unless we got below this low on the S fund, I'm not too worried about it. If we get below this low, we get a problem. If we get above this high, and particularly this high, then we're likely to keep on going higher. I fund. We've been talking about it for a while. I fund, ever since this breakout, has been doing really well. Much bigger move higher than the C or the S funds. A constructive pullback a couple of weeks ago to that 20-week moving average line. A big breakout from there last week, and kind of a consolidation week this week. Didn't do too much. RSI well above 50, MACD positive and expanding to the upside. I fund looks really good. F fund, I think, is for me the most interesting, and we'll see how it goes. If the I fund is going to be very relative to what the Fed does. Either this is a significant low for the F fund, or we have one more move down, and this would be a significant low. We will see. In the meantime, we basically have this sideways consolidation. We'll see what happens. We had a breakout by the end of the week this week, so this is a good thing. Today's Friday. The market is closed for Good Friday as we're recording this. And yield on the 10-year yield is way up, which means price on the F fund, if it was open for trade, would be way down. So we would have gotten out of this. This breakout would have failed on the F fund if the market was open today. So it'll be interesting to see how it goes going forward. But that is it. A lot of
questions.
A lot of stuff in the show. I feel like it was a little bit disjointed, but
there's some good things to pull there from the two people. You kind of showed how I like how the two different perspectives can overlap, right? Yep. You can see. That's why it's always good to look at multiple. If you're getting your you're getting your information from one place, you might be able to get some different perspectives from other places. That's why we try to introduce you guys to other different people, right? It's not just us, because we certainly don't just look at one thing. We're all over the place, always looking for new opportunities to look at this in a different way. And the good thing is the stock market's been around a while, so you can tend to find people that have locked on to some pretty significant trends. I would say most of those people, the kind of older folks, are kind of like, what was the first gentleman?
Jeff Hirsch.
Yeah, that's like long term. Making 2 moves a year basically.
Yep.
Right. Here's when you get in. Here's when you get out. And again, if you go back to like my grandparents' days when I would listen to them talk about the stock market, that is kind of the way they did it.
Yeah.
I mean, my grandfather would wake up in the morning and he would read the newspaper. At the back of the newspaper, he would look at the stuff, and he wasn't moving in and out every month. Right. He wasn't, and so looking back on that's because that's, that was the way they were trained.
Right.
If you were educated about it at all, you certainly weren't trading yourself because that wasn't possible back then.
No, it wasn't possible at all.
Yeah, you had to call someone and they had to call someone.
Yeah.
And it was a whole different world back then. But anyway, point being, look at other people's information, take it for what it's worth. I would say be wary of, most people that watch this show, I would, based on the numbers that are the demographics that YouTube and social media share with us, we're looking at people in their 30s and late 40s and that age group, the reason I bring that up is if you're running across somebody on TikTok or Instagram or something that's like been doing this for a year and they're telling you how everything works, and you gotta take that with a grain of salt. Right. Yeah. It needs to be hopefully someone that's been doing this for years. Doesn't mean they can't be young.
Sure.
Because I know plenty of people out there now that have been doing it since they were 15 to 25.
Yeah.
Right. And they're a 25-year-old, quote unquote kid, but they know their stuff pretty well because they've been doing it for 10 years and they're smart already. I'm just saying, do a little due diligence there. But
I have to do a little rant for a second. You know what drives me crazy? I hear it. Now I feel like it's all day, every day.
I want to zoom in on you,
but it's on Bloomberg and CNBC and like all the financial media, and like you always say to the narrative, they have to be trying to reinforce this because they say it all the time. If you weren't around before 2009, you don't understand anything that happened before 2009. Like you can't read a history book. Like you can't go back and look at things.
Yeah, if you weren't really into it back then,
right.
Maybe you were 12 and you weren't, but now you're not.
So I wasn't in this. I came into government service in 2010, let's say, and ever since then the market's gone up, and so my predisposition is going to be buy the dip because that's how it's always been for me, right? But that doesn't mean that you are incapable of asking, reading. Hey, what happened before I got into the government? Wait a minute, didn't these old guys are talking about they lost half their money? Like maybe I should take a look at that.
Yeah.
Everybody talks about how if you weren't in the business back in the day, you can't possibly know what's going on. It's nonsense.
Yeah, yeah. But you know what? But it's not surprising, right?
No.
Because it's human nature a lot of times for people to be like, well, you don't know because you weren't around. Yeah. And I'm like, well, you're right. If I wasn't around and there's nothing written about it, I'm not going to know what you're talking about. Right. But this is pretty well, definitely pre-2008, right? Yeah. The internet was still around. So you can do some digging pretty quickly and easily if you're so inclined to educate yourself. But I would say that you should.
And even if you were around, a lot of people that were around, they're not necessarily any good at this stuff either.
Oh yeah, well that's for sure. They just remember what that pain felt like. That used to be my story all the time about when we kind of started. We knew each other before, but I didn't really understand, the importance of what you were doing until that time frame when I sat in my office and heard grown men cry at their desks because they just lost half their retirement, and it took them years to get it back. And these were, older guys and gals that were ready to retire. In their 50s, like, hey, I'm out, and they're like, in the course of a few weeks, they've got half the money.
So you know why that was back, and maybe to the point, this is something that unless you lived through it, you would know it. That was back when everybody was in the I fund. Now everyone, CNS all the way, right? Yeah. Back then, the I fund way outperformed the C and the S funds. And the people that were in it were making a killing, right?
Yeah.
But like you just said, it only took a few weeks to flip. And the I fund never came back.
And they didn't get out.
They didn't get out. No, of course not. Why would you get out? It always was up.
Well, there was a little newsletter that went out by email by this buddy of mine that worked in the office, and he was like, get out. And I was like, TSP, I'm out. And then I went back to work, and I did my emails and did all the things. And I was out. And I was thinking to myself, because, we used to get those I don't even know if they still send them anymore because I don't get them. But the little graph that they send you about how your account's
TSP
doing.
Yeah.
And so, mine never went down. It didn't, fly up, but it was always pretty steady because I was following your newsletter, and I was like, why is everybody crying? Like, what's the big deal? Because I wasn't engaged in that. I was trying to chase bad guys, right? I wasn't chasing anything in the stock market. But yeah, so I mean, part of that, I guess that the part of that perspective is that you were talking about, that people say that. I mean, it's partly true, but it's also like, you're right. What you're doing is assuming that that these folks are not smart enough to go, read a book or go to a website or like research. It doesn't take much research. You just Google it, right?
It doesn't take much.
Yeah, but you can definitely be informed about what happened before then. But you're right. I mean, there's a couple of folks on Bloomberg that as soon as they start talking, I turn it off.
Yeah.
And I never used to watch Bloomberg that much until we put it in the office, because I was more like I like kind of like Yahoo Finance and a few of the with just like some younger perspectives. Yeah. I liked it, because I feel like Bloomberg's a bunch of old fuddy-duddies.
It is. Yeah.
But anyway.
But you can't have the young perspective because I don't know anything, because I wasn't there back in the day.
Right.
Yeah.
All right, guys. Hope you enjoyed the show. If you're still watching at this point, and if you have any questions, put them in the comment section wherever you found the video. If there's no comment section, just shoot us an email at support@growmytsp.com. And you guys have a great week.
Out of here.
Boom.